Good morning, REC Nation. Happy long weekend. It's a beautiful day outside here, at least in Toronto, and we have a great discussion today. I'm going to do my introductions like I always do. My name is Tyler. I run our real estate coaching division here at REC, and I do a segment of Brunch with REC called Real Stories with Real Investors. Today's discussion is going to be a little bit different. We don't have an REC insider joining us today, but we do have our head of pre-construction. His name is Luc Leasing. Luc, thanks for joining us.
Thanks for having me on, Tyler. You're talking about how it's a nice day outside. Can we talk about this killer shirt you got going on?
You know, I was looking in my closet today, and I actually really appreciate you asking about it, because when I put it on, it's like, yes, this is a long weekend vibe. So I
like
appreciate that. I love this shirt, actually. This is one of my favorite shirts I wear. I don't wear it enough. I gotta wear it to the office more. I should do more real estate action plan discussions with it on.
Love it.
Naturally, people are going to talk about more short-term rental opportunities. They're going to talk about buying cottages and homes in Jamaica and Barbados.
Boom. Boom. And you're the tenant.
That's it. I'll be there. We can work remotely now. Jazz has us coming into the office, but we can work remotely.
That's it.
So the reason why we have Luc joining us today is we've had a very busy 2 weeks at REC, not including our residential division that has also been very active. Luc and our pre-construction department division has helped 15 REC insiders in the last 2 weeks purchase and select some fantastic pre-construction opportunities across the GTA, and our insiders have actually closed on $15 million worth of real estate. And instead of having 15 insiders join us and talk about their real stories, I think the conversation will get a little bit confusing with everyone speaking at the same time. We wanted to get Luc on our Brunch with REC and talk about a little bit more of what he's noticing. One, the pre-construction sector in regards to how the market is ever evolving, especially right now, as well. Some of the main talking points or discussion points that we're hearing from REC insiders. Out of the 15 insiders who have executed a deal and purchased a pre-construction opportunity, we've had a few hundred conversations with insiders who are considering it. So I wanted to today, Luc, just talk about a few things, but through the conversation, go and discuss some of the main talking points that we're hearing insiders. The reasons why they're getting into this type of asset class, some of the reasons why they had to back away from a unit that we've selected for them, and talking about some next steps. Before we do that, I did want to touch a little bit on the market, and I know you and I were talking about this before we hopped on the live. This market is changing really quickly, eh?
Yeah, absolutely. And the reason being is because we still haven't fixed a number of issues. Like what a lot of people don't realize is that the government doesn't create housing with it, like physically. They don't construct these condo buildings and these subdivisions within our province. It's these private institutions, such as these developers, these condo builders that we work with. They're the ones that actually build these housing units. And why I bring that up is because the government is putting in a lot of things to encourage builders to build. And on top of that, we still don't have enough housing units to accommodate for all the new immigrants coming in. So to your point, I mean, like the market has tremendously shifted. I was just reading a report.
Yeah. Oh, no, I was just saying supply, just to touch on that point. Supply is still a challenge. We saw it over the last year and a half. We're down 40% year over year with listings, and that's just on the resale market. And, we couple that with the return of the buyer's confidence.
Yeah. So what does that look like for actual numbers? So you and I, Ty, like we know interest rates haven't come down one bit. It's only ever gone up or have stayed still. But if you look at January in the GTA, the average selling price in January across all property types was $1,050,000. Fast forward to April, it's now 1.150,000. So we've seen a $100,000 increase over 90 days, but interest rates haven't decreased. Why? It's because people have adjusted to the higher interest rates, and the market is still now continuing to do its thing. So if you got into the market 30 days ago, or excuse me, 90 days ago, boom, you would have made $100,000. because that is what values have gone up by over the last 90 days.
So we had an insider purchase something in Grimsby. It was a duplex. No, sorry, Welland. It was a duplex turnkey that they bought for 575. We have other insiders looking in that area right now. We can't find anything for 650. And not
Wow.
she closed on that in December.
Wow.
So it's we're seeing like even buyers right now who are looking for primary residences, like some of our clients, like they've been putting in 9-10 offers over the past 3 weeks. They're competing with 25 other purchasers, and it's
Yeah.
the supply. It's not more buyers on the market. I personally believe it's just people who would have normally sold, they're holding on, right? They don't want to jump into a market where they're competing for their primary res on the purchase side. So, we haven't seen the supply hit yet, but I think it's going to come now that we're starting to see some more buyers come back. Neighbors are now finally going to see what their neighbor sold the house for, and they're like, maybe it's time. So, it should be coming back. So on the pre-construction side, I do want to first talk about kind of developers' mindset, because you're sitting down with Jazz, Simeon, and developers going through due diligence. And how have you found over the past, call it, since February 2022, since we started to see interest rates going up, have you found the amount of development that has hit our desk gone up or gone down? Like, have you seen more or less developers launching projects?
I think the amount of projects being launched has stayed somewhat consistent. I think maybe at the start of the hikes, the interest rate hikes, I think maybe there's a tad bit of a hesitation seen from developers, but I think it wasn't necessarily hesitation. I think it was just them getting trouble, for getting permits and things of that sort. So the same amount of projects have been hitting the market. However, activity has obviously changed alongside with the rest of the market, right? Instead of prices coming down significantly, however, in the pre-construction market, we see that developers are actually offering different incentives, things like rental guarantees, even further extended deposit structures, things of that sort.
And cashback incentives. That's a big one I've seen over the past year and a half.
Yeah, we've seen a lot of cashback incentives, which is nice because that'll cover for your closing costs or whatever it may be at closing.
I always say, like, if you have rental guarantee versus cashback incentive, I would lean towards cashback incentive personally. Because you can go and we have low vacancy in the areas that we're selling anyways, and we can rent it out and you still get that cashback incentive, which reduces your closing costs, which is significant.
Yeah, I really like rental guarantees. However, I completely agree with you. And the reason being is because the stats for April just came out. The GTA's vacancy rate is 0.6%. We have pretty much a 0% vacancy rate, and we have multiple offers on rentals. So you have an abundance of tenants to choose from, and rents themselves, because interest rates are so high, have gone up year over year 12.6%. So we have an abundance of tenants. We don't need a rental guarantee. The GTA is your rental guarantee, not the builder. And if you have the opportunity if you have the opportunity to take a cashback, just take it.
Yeah. Oh, I would all day. And also, you have some strategies with listing the property for lease. I know I'm going off tangent here, which I always do, just so you know, on the Brunch with REC. I just think of a question, just ask it. So the strategy, because it's built after 2018, you don't fall under that rental restriction limit of 2.5% that it was this year. You can raise it to whatever market rent is at the time. For everyone listening, I believe that the first round of tenants is always the hardest to find when you close on a pre-construction condo. The reason being is that you're competing maybe with 40 or 50% of the building who are investors. So, you got to put your best foot forward. And I personally believe just kind of working the dollars and cents, listing it a little bit lower than market value to attract that tenant, the right tenant, is, I think, better than having it at market rent and leaving it vacant for an additional 30 days to find the tenant. After a year goes by, you can actually raise the rent to whatever market rent is at that time. So, and then at that time, if the tenant decides to leave because of the rental increase, it's a little bit easier because you're not competing at that point with 40, 50% of the building.
Yeah. And 95% of the times when you invest in pre-construction and with REC, you have something called the right to lease during occupancy, which means that even prior to closing, you're going to be collecting rent, which is actually great because you're going to be having a lot of cash flow coming in. And then, Tyler, you say it all the time to our insiders looking at this strategy. Use that cash flow you get as a slush fund, save it
Oh
to the
yeah.
side to offset any negative cash flow in year one. So you can be still positive cash flow, or worst case scenario, break even just from that incentive alone.
And I love it. That's what I tell everyone to do, even with their residential investment. Just keep a little bit, right? Keep a little bit of a slush fund back, because you'll have vacancy, you'll have repair that you'll need to do. A little bit less
Yeah.
obviously with the new build condo, but still, it happens. So, kind of going into what you're noticing, because you're having hundreds of conversations now with investors who are interested in pre-construction, and we did have 15 of our REC insiders purchase units. They tied up $15 million of real estate over the past 2 weeks, which is incredible. Congratulations to anyone who purchased. In regards to, let's go into the first the 15 who did purchase. Do you have an overall kind of idea of why they decided to purchase pre-construction? Why they wanted to add that to their portfolio?
Yeah. So two main reasons. One, the extended deposit structure. With pre-construction, you can effectively tie up real estate at today's values, but not have to close on it for 3 to 4 years. For this project in particular that you're referring to, Tyler, it's called Above Condos in Mississauga. And we did a presentation, I think April 2nd or 3rd with
You did a great
the
job on
CSMO.
that.
Thank
You did
you.
a great
Thank you.
job on it.
Thank you. Yeah, we had Aaron Miller on, and we had about close to 100 plus of our insiders watch that presentation, and and what really attracted them was the fact that only 5% was required every 12 months.
Mm-hmm.
What does that mean? So if we're looking at a $600,000 condo, I know 5% is $30,000. I need that today. I need that in 12 months from now, 12 months after that, et cetera, et cetera. $30,000. If I'm not able to save 30 grand, I can bring in a joint venture partner, go 50-50, and now I only need $15,000. Because this strategy is so digestible, it allows both the new investor that's just getting started and as well as the experienced investor that's tapped out to be able to still add units to their portfolio
Yeah.
and take advantage of the GTA market. So that's for one. And the fact that now you're actually also allowed to borrow when you close on it on the new appraised value. So you can actually refinance the same day you close on it. So you could pull out your equity much faster. And
Yeah. Pay
shout out
yourself back
to
essentially, right?
yeah, completely. So shout out to our good friend Santino. He called me yesterday because he's closing on a project next year. And even during this downturn in the market that we're seeing, I just did a quick one on comms for him, and we saw that his specific unit was probably selling about 90 grand more than what he paid for it. Even in this downturn that we're seeing, in the peak, he probably would have got a good buck 50 or so. So this is why we
And
like
it, yeah.
pre-construction. It's very safe, and the returns have proven to be there.
And I think one type of incentive we can still negotiate right now, because we did have over the past year a bit of lack of buyers presence even in the pre-construction sector. So developers were offering types of incentives. We already touched base, right? The rent to guarantee, the cashback incentive. The cashback incentive, we saw that on a good handful of projects, even the ones that we didn't bring to our REC insiders. That's one, call it like 2020 and prior, I very rarely saw. And the cashback incentive as well as the extended deposits, that 5% per year, we weren't seeing that in 2018. The developers wanted 10% in the first year. We'd always try to ask for it and they would laugh us out of the room, right?
Yeah.
I think that was obviously an incentive to incentivize or to bring investors and purchasers in. You don't have to put all your capital down at once, but I foresee, because of the buyers jumping back into the pre-construction market, I don't know if we're going to see that for much longer. Those types of incentives.
Yeah, even the projects that we're currently working on right now, like there's a few where we've allocated units, and then they told us that some of these incentives are a little bit outdated, but obviously we would negotiate to get them back. Like we're seeing it happen in front of our eyes, and
Yeah,
the
real
strategy
time.
of pre yeah, yeah, but we still like to look at master plan communities. We like to look at places that are developing. Like for example, like we just mentioned, one of our insiders closing on a project early next year. This one was at Keelan Shepherd. We were very bullish on this area because of what was coming to the future.
Mm-hmm.
Because right next to this project was the former Downsview Airport, which sold back in 2017 or 2018 for like $817 million. But why is that important to follow? Because we know now that there's no airport there, we know now that the building restrictions in terms of how you could build has been removed. So now we're starting to see skyscrapers. So now there's like a 300-acre master plan community just because that airport got removed. And now we're seeing our investors get in at the start of that revitalization. And following trends like that is very key because that's where most of the growth's going to be.
It's changed that specific area of the Downsview Park area and surrounding, like even around Yorkdale's changed so much in the last 6 years.
Yeah, completely. And
It's,
I think we have Treddy coming up as well.
yeah, Tretti's now actually. Tretti's now. They're in occupancy
Yeah.
now. And then there's Nordic condos there. There's the Keeley that I believe you were speaking about. The
Yeah.
Keeley is
Yeah.
and even delays. The thing with delays, because naturally with builders, I don't think I've ever worked a project that the builder's been on time with their projections.
Yeah.
But if you're looking to live there, sometimes that delay is challenging. But most of the time, the delays actually help because your values are still increasing without you having to get a mortgage yet or pay for the closing costs. So that's great. So just going back to the original motivation question. So the first thing you said was, taking advantage for above condos with that extended deposit, not putting down your capital all at once. Another advantage that I've seen anyways, and maybe we can touch base on it, is that you don't actually have to get a mortgage for 5 years. And with the current state of the market, with interest rates being higher, it gives you an advantage to get in at today's prices and not have to get a mortgage for 5 years at potentially a different time.
Completely.
Right. So
Yeah. Yeah.
that's a great motivation. And then what about, condos being passive? You want to touch a little bit on that? Because I think that's another natural one that we've seen for a decade now.
Yeah, I mean, so to your point about it being very passive, a lot of our insiders here are like they have full-time jobs, they have families.
Mm-hmm.
Like I myself, like I'm blessed because I have a full-time job, but I'm not busy running around with kids such as yourself, Tyler. But even then, I still choose to invest in pre-construction because I'm so busy with work.
Yeah.
I have I have a full-time job, right? I can't be managing a property in Weldon. I know some of our insiders can, but I personally won't be able to manage that. And because of that, I would still like something very passive. So what do I look at? I look at something that's very safe, somewhere where I know the rental vacancy is going to be low, such as Mississauga, Hamilton, Toronto, if you can afford $1,600 per square foot. And if you could, then you want to look at these things because you don't have to worry about the investment overall for 4 to 5 years,
Yeah.
only your deposits. And even when you go and close on it, because we have such a strong tenant pool in GTA, as soon as you find your renter, you probably won't even have to think about them for a year after that. Very passive. I know some of our insiders like to dabble with the BRRRRs, the short-term rentals. That stuff can provide a great return. I think I like to say that in real estate, there's a bunch of ways to skin a cat, right? Like there's a bunch of
100%.
ways, right? Like it's just
That
about how you want to approach it.
and that's the best part. I think I have real estate action plan discussed. I've had over 100 this year, and I motivation's different, and what you're trying to get out of the investment is different. But I think that's one of the best things about investing in real estate. There's so many ways to succeed, and my strategy and your strategy could be different, but for us it works. And I love that you said that. It's so true.
Yeah.
It's not a cookie cutter. It really isn't. Um,
Yeah.
and like to talk about being passive. So even on the resale market, condos can give you an ability to buy in a market that's not close to you, but you're still you can still manage it from the phone. And an example of that is myself. I have a condo in London. It's a 3-bedroom resale. I bought it. It was built in the 80s. I bought it a few years ago. I've had some turnover with tenants. which is the only time you really have to be there. But I personally just use a real estate group there, 1 month's rent, just to help. But everything else can be handled through the REC concierge division, through yourself just having your all-star team there. That includes handymen, that includes landscapers if it's like a duplex or triplex, that includes your electricians, your plumbers. And an example was a few months ago, I had a call from a tenant. Our tenants are great right now, so I got a call from them. It was Sunday at 7 a.m. Luc, if you ever get a call from a tenant on Sunday at 7 a.m., I guarantee they're not calling you asking you how you're doing. It's usually something up with the home. So she called us, and I picked it up, and she's like, "Hey Tyler, I heard a loud noise from the bathroom, and now there's a lot of water dripping." And I was like, "Okay, can you please hang up the phone and video call me?" Again, I'm still at home. She video called me, and I saw a massive bubble, obviously
Wow.
caused by the unit upstairs. And what I did, because condos are really passive, all I did was I called 3 plumbers that were in our real estate concierge list. One of the plumbers was able to do it. I got him there by 9 o'clock. He was in the condo. He had to tear up the ceiling, go upstairs, and then it was caused by a bidet that was installed incorrectly. So go upstairs,
Oh wow.
fix the leak, and after that, all I did was I had the property management company on site coordinate the contractor that they use to go and fix the bathroom. All of that was done by the phone. I had a dishwasher that wasn't working. I just called a technician and came in. I just have the tenants coordinated. The only thing that I would recommend doing is if somebody is closer to the property, if it's in the GTA, call our concierge division, and at least have someone once a year, maybe twice a year, just to check in on the home. That's it.
Yeah. Yeah.
Passive. It's
So
such a passive opportunity.
yeah, I mean, you're in a great position because your tenants are great. They're always paying on time. They work very well with you. Why our investors also like pre-construction is because in the event something like that happens, Tyler, and maybe they're not able to get a plumber in time to fix a poorly installed bidet, in pre-construction, you automatically have carry on home warranty. So for 7 years,
Mm.
your unit is protected from damages like this that may come up. And it's just as simple as making a phone call to getting it fixed. So yeah, there's a number of different advantages. The message our insiders should get just from watching this, because as I mentioned, from January to April, we've seen a $100,000 increase in values. Doesn't matter what you invest in, just invest. Now, we were telling our insiders that last year when rate hikes went up 8 times in a row, because we are investors ourselves, even myself, I purchased something in November of last year or October of last year. So as the interest rates were hiking, I personally, even myself, I invested in a unit in Hamilton. So it's not like we're just saying this because like we're salespeople. We're investors first. This is what we do, and then we present opportunities that we like, that we've invested into our insiders as well, so they can also get into the same projects that we're investing in, the ones that we have our eyes on.
Yeah, and then why don't we touch base on due diligence? We get a good number because of our prevalence in that pre-construction asset class, in that market. We do get a number of developers, and projects on our desk. What are that due diligence checklists that we have at our EC? Why don't we go over that?
Yeah, the first and most important one is location. Why is it important? It's because in pre-construction, the moment you invest your deposits into a project, it's tied there until closing, which is normally 3 to 4 years later after the launch date or the day you invest. That's normally the average time frame. Because it's tied up for that long, and because we always look at things in 10-year time frames anyway, you want to make sure that there's a number of different things in place in the location that you're investing in. One is the transit or future development of transit, because most of your tenants are going to be near major highways, public transportation such as GO, TTC, subway, via lines, et cetera, et cetera. You want to look at things like that. Employment. Do people actually work and live in this area? I myself, I just moved to a place at Don Mills and Shepherd, but my office is at Don Mills and Lawrence. That's perfect because like I'm a perfect example. I want to be as close as possible to work. Whereas back then I used to live in Scarborough, and now my commute to work was about 35 minutes. Now it's like 8 minutes just to get to work. It's much
Yeah.
easier. And with gas prices being the way they are now, I can save significantly on gas. Um, Transit, employment, things of that sort, future growth. We talked about Downsview Airport, how it's sold, and now they're revitalizing the entire neighborhood, and how we're getting in at the start of a massive revitalization. I was just in Vaughan yesterday, and I was driving past a couple of the buildings that REC sold before COVID. The Transit Cities, now the festivals by Menke's, and
Yeah.
and I'm seeing a significant number of new buildings coming up, projects I've never even heard of. And then when I quickly do a Google search on some of these price lists, I'm seeing the amount of money some of our insiders have made. Like I'm seeing one bedroom selling in the high 700s. It's ridiculous. And I could just recall some people that bought a few years back in the low 300s or the 400s at Transit City,
Yeah.
right? So these things where you get in at the start of an early revitalization, those are like that's the first of our due diligence checklist, that location aspect.
You can't pick up the building, right? The-
You can't. Yeah.
So location, and then obviously developer, if they're reputable. I heard you say this, and I'll touch base on it. In regard to the developer itself, not that we think that a developer doing a high-rise development for the first time is means that they're going to build a bad building, but we just don't want any of our insiders to be test subjects for this specific builder. And maybe we'll touch base on what are the requirements that we need to have in a builder.
Yeah, so REC has had their fair share of working with difficult builders a long time ago. We've been in business for coming up to 2 decades now. So with the amount of experience we have, we know what to look for and what not to look out for. Not from Google searches, because just of the experience that we have. So normally the bigger names that we work with, the Marlin Springs, RioCan, Green Park, the Tridells, the Dan, like these names, not only is it because we've worked with them before that we trust them, it's because of also the reputation. How do we look at a builder's reputation? It's as simple as looking at their own website to see what they have completed. If they can give you a long list of projects as well as the units that have been completed, that's a great place to start. If you want to take your due diligence down even further, you can look at private real estate forums, Reddit, a lot of these platforms where you can actually just see what people are talking about after living in these buildings. You'll see what what a couple of comments that these people have to say. Like if you look at Tridell's reviews, people will say, "Oh, I've been in a Tridell building for 10+ years now, never had once an issue. The concierge is always so friendly." These are the kind of things that you want to look for,
Mm.
because a builder, like there's some buildings in Toronto that we've never touched where a builder might construct it very poorly and they refuse to fix any of the problems, and over the long term your maintenance fees continue to increase because there's lots of
Yeah.
problems in the building
Or,
and
or
the
not set up the
values
reserve
don't
fund,
show,
or not set up the
or not
reserve
set
fund
up
properly, right?
completely.
I,
And I think you
I,
and I are thinking of us the same few projects.
it's always important, and I think that's another good hack as well when you're doing research on a specific builder is reach out to a local realtor that has access to MLS. Give them the addresses on the condo. You can reach out to myself or Luke as well, and you can see the ones that have already been completed. Let's pull a few listings. Let's see how much the maintenance fees have increased.
Yeah.
Let's see how the values have increased year over year. And I think that that's a good indication. Days on market, we can see how fast things are selling, and that's also a location aspect as well. But it could mean that some people really love that building or don't,
Yeah, completely. I think just
right?
the
So,
easiest place to start is just how many projects have they done. Have they
yeah,
done a number of projects and you can recognize even the building addresses? That's a great place to start.
yeah. And one other thing I think, anyways, is important is that the builder has current construction. So someone could have been a great builder 20 years ago, but the construction market's evolving, right? The labor costs increased, material costs increased, maybe the permitting in certain areas have changed. So, it's good to work with someone or a builder who does have completed projects that we can pull data from, as well as ones that are currently being constructed.
Very true. Very
That's a
true.
perfect storm, though. It doesn't happen always, but that would be the perfect storm.
Very true.
So then we have first location, builder, and then the last one I'll let you touch base on, which is incentives, which we spoke about a little bit. But why don't we go over more like kind of high level? What are some of the incentives that are needed, and then some things that we can try to negotiate?
Completely. So the three needed ones that are a must in any project. The first is the right to assign. What does that mean? The right to assign is a clause that allows you to flip the paper or sell your contract to another buyer, assignee, prior to occupancy. Why is that important? Because let's just say, for example, we bought a unit back in 2019 and now it's 2023 and interest rates are 5.5%. And in your personal scenario, you're not able to get the mortgage on 5.5%. Before we assign it, we're going to help you try to do other things like bring in joint venture partners, things of that sort. But let's just say absolute worst case scenario, we just can't close on it. The right to assign allows for you to exit the deal prior to occupancy. So that means you don't have to close on it, which means you don't get the mortgage, nor do you pay the closing costs. There's a few fees associated with that, but that's ultimate key. Some investors use this as a strategy to make money. It's not a bad way to make money. A lot of investors make a lot of money with this strategy. However, we prefer that you still close on it so you can refinance it instead. So you can still hold the asset and also still access the money without having to sell it. But again, number one is right to assign. Number two, we touched on this very briefly earlier, is the right to lease during occupancy. In pre-construction, there's two stages to closing. The last and final stage is final registration. That's when the building is fully constructed. And that's when the title gets transferred into your name. You pay your closing costs, you get your mortgage, etc. Prior to final registration, you have occupancy, which normally commences 3 to 6 months, maybe a little bit longer, maybe a little bit shorter before final closing. And at that point, the building is about 90 to 95% complete. But because it's not fully registered yet, the builder can transfer title into your name. What they do is they start to move people into the building. They work from the lower levels all the way to the top. At this time, they're going to be paying you an occupancy fee, which normally ranges anywhere from $1,000 to $2,000 a month. So if you're not collecting any rent at this time, you're going to be cash flow negative a significant amount of money.
Yeah.
Whereas on the flip side, if you have rents coming in, your cash flow positive is going to shoot through the roof because you don't have mortgage payments. So that's very crucial. Last one is the capping of development charges. And what development charges are, it's a fee that essentially the city is going to charge the builder so that the city can build city infrastructure to accommodate for this new development. Things like adding traffic lights, parks, readjusting the sidewalks, sewage connections from the city to the building, things of that sort. The city will have to charge the builder and the builder will share some of those fees onto you, but it's important we have them capped so it doesn't exceed a certain amount. Those are pretty much like the three main incentives.
You need to have those. Like those are ones, if you buy with REC or if you don't, you got to make sure in Ontario anyways, that those incentives need to be there. And just before you go into additional incentives, because I think that's what you're going to be talking about next, I don't care how much the condo's appreciated in 5 years. If you can't lease it during occupancy and you incur 6 months of vacancy plus, to me, it doesn't work.
Yeah. If you're cash flow negative, $1,500 a month for 6 months, that's like $9,000 right out of your pocket.
Yeah.
Right. So on the flip side, if you're cash flow positive, $1,500 a month for 6 months, that's $9,000 positive. Right. And that we can use to go to the casino Niagara Falls or use it and put in your, slush fund that we always talk about.
That's right. Or we could buy more shirts for me.
There you go. I don't think it's going to cost you $9,000, but you'll have a boatload of them.
I could go to, what's the one? Tommy Bahamas. I could go to Tommy Bahamas and buy all the surfing shirts. So
that's so funny.
So let's talk about some additional incentives. And we touched base on this already, but what are some that you usually see in your traditional, pre-construction investment?
Yeah, I think now that the market has, I would say over the last few months, now that it was quite slower in terms of sales activity, the investors that got in at such a great time because
Mm-hmm.
they just snagged up extra incentives that were never once offered before. Like for example, like I've seen cashback of incentives of like 23 grand at closing,
Yeah.
uh,
Oh,
which is ridiculous. Imagine just another 23 grand that you get back. A handful of our insiders took advantage of those projects last year. So cashbacks, big, such a big bonus, because when the market was heating up, we had the three main incentives that I mentioned, but we never had 23 grand back coming to us. But some of
yeah.
our insiders took advantage of that. To your point, some of them took advantage of the extremely extended deposit structures, because normally 10% is needed within the first 6 to 10 months. Now we don't need 5% for 12 months. That's a huge advantage for those looking to get in and also save some of their capital and not have to use it up front, things of that
Mm-hmm.
sort. And we still have our free maintenance fees for a year, free property management for a year. Some of these are the bonus incentives that we get. And now that the market is starting to pick back up, I know this from personally speaking with builders, they're removing some of these incentives now, because
Oh
now they're
yeah.
starting to see that they don't need to
They don't
offer
need
it.
to. They don't need to.
People people need to buy it.
Yeah. No more free
Not they
locker.
want to buy it. Yeah, no more pre-lockers. It's not that people want to buy these projects. People need to buy them. They need a place to live, which is why builders are starting to remove these incentives again.
Mhm.
So we still have like a small window of time where some of these incentives are still here, but even when they're gone, it's gonna be a tough one to get back.
Yeah. I agree. And the traditional ones though, the extended deposit, like we had, what was it? Was it Design District or Television City that had the 5% down total?
That was, I think, one of the towers or one of the phases at Television City. They had like a quick promo for like 5% only.
Yeah, for like the few of the remaining ones they needed to sell.
Yeah, that was like last year. Uh, we did Design District recently, I think, at one of the summits. It was like 10% in the first 7 months, which is closer, but nothing else for 2 years.
Yeah.
So that 2 year gap was great. And then the one that we're working on right now in Mississauga is 5% every 12 months.
And then uh, I want to go down a rabbit hole for a second, but before I do that, I know Jazz is probably watching right now and just saying you have to talk about the event that we're hosting. So, for everyone listening, we are going to be hosting our next REC educational event. It's in person at our office at the shops at Don Mills. So Don Mills and Lawrence. It's gonna be a great event. It's a Tuesday evening, again May 30th. We're starting at 6:30 p.m. and we're gonna have a special guest. We have Darren Boros joining us. He has 20 plus years of experience in the multifamily sector, and we're going to be discussing everything that surrounds multifamily investing, how to secure an opportunity, how to screen and find, which I think is the one of the hardest parts with multifamily as well as pre-construction. But multifamily, a lot of the time, it's more off market. So how do you find off market deals as well? What Darren does in his portfolio is he specializes in adding units to his pre-existing holdings. So he's going to be talking about some of these zoning changes that we are undergoing in Ontario and how to take advantage of them as investors. If you are interested in coming, send us an email, info@reccanada.com. Nick's going to put that into the chat now, and put the subject line something like event or multifamily, something like that, and we can have someone on our team register you. Oh, right here we see it. Yeah, the subject event May 30th. Put that in there. We can register you. We have at this point, I think about I have the number here, 60 REC insiders who have registered. So spots are filling up rather quickly, but we still have some time. It's gonna be a great event. Luc and I will be there. We're gonna have some hors d'oeuvres. We're gonna have some wine. It's gonna be a good discussion. So everyone register if you're available. I want to see everyone there who's in the GTA. Now to go back, Luc, to this extended deposit structure. So above condos, remind me, it was a 5% deposit per year every 12 months.
Every 12 months.
What was the one bedroom condo starting at?
You
Price.
can get something like, I know some insiders got in under 600, some got in a little over 600, depending on the square footage, but you can use 600,000 as a round number.
Okay, so 600, that means 5% is 30,000. So they can secure a unit for $30,000.
Yeah.
They just have to, the insiders and the investors obviously have to be comfortable with the scheduled payments. So
Correct.
something that's really interesting, well, not interesting, it's a strategy that I'm speaking to a lot of insiders about more and more, but we've been doing it at REC for coming up to 2 decades. It's a pseudo laddering plan.
Hmm.
And projects like above condos gives the investor the ability to do this. One, obviously, they don't have to put all their capital down in the pre-construction condo at once, but then you also don't have to get the mortgage for 4.5 to 5 years. So I need to draw it to visualize it. So let's say I draw an arrow pointing upwards on a page. I do this for insiders every day. Year one's at the bottom. Year one, if you have the ability to secure a pre-construction condo as well, once you secure your condo, you know the scheduled dates. At that point, speak with an investment focused mortgage broker, which you will be anyways, actually, when you're doing your mortgage pre-approval for the condo, for the pre-construction condo, and look into with your remaining funds in your investment portfolio, or some of your remaining funds. Look at an income property, residential, duplex. Our insiders are finding a lot of success in the Niagara region, Niagara, St. Catharines, maybe Hamilton because of the development. You can get a turnkey duplex in the mid sixes, 680 to 700,000. So drawing it, let's just say we're looking at 700K. That's $140,000 you'll need down for the income
Hmm.
property. Find something with cash flow, and I'm fairly confident we can right now, because you told me 14% in the GTA. In Niagara, we're almost at 22% year over year increase in rent. They're catching up to
Wow.
GTA prices. So
Wow.
so you can get some cash flow there. So we buy a pre-construction condo, 30K down. We'll buy an income property for, call it 150, 160, including closing costs. That means that we'll be putting down in the first year 190,000. And this is why I think doing both, if you have the ability to, is will help maximize your returns in your condo and while leveraging your income property. So that's year one. In 5 years, all we're doing for the condo is we're paying off those incremental deposits. It's such a hands-off investment for the first 4 to 5 years. The income property, what we would be doing is, I personally would draw a plan out where we don't touch the equity for 5 years. We just let that nest do what it needs to do. Rent it out, get some cash flow, and even at a 6% interest rate, we're getting some cash flow. Once that goes down to the mid fours, 3 years, 2.5 to 3 years, I would think anyways. We're starting to now get a little bit more cash flow there. At year five, because we've now had conservatively 7 years of passive appreciation in this income property, we have the ability to refinance the income property, pay yourself back the 20% that you've put into the pre-construction condo, and now that income property has now essentially, based off of the appreciation that you've leveraged, has now paid for that condo. You put that capital you put from the pre-construction down payments back into your property. And then with the pre-construction condo, as you touched on, and I'll talk about it a little bit more in detail, you now have the ability, this essentially, this income property is now paid for this condo. The rise in rents, as well as the that refinance amount, your tenant in your income property is going to be paying for the majority of, if not all of, that refinanced amount. You put that towards your income property, again, get that 20% down into your pocket. And now this condo, essentially, whatever happened in the first 5 years of appreciation, that's bonus.
Yeah.
You then have the options. And I think the sweet spot, as you said, I think there's two sweet spots to maximize your leveraging your appreciation in pre-construction condo, in this pre-construction condo. The first is what you said, right? There are some lenders that allow for you to get a mortgage at the appraised value instead of the original purchase price.
Right.
And that's where I think speaking with a good investment focused mortgage broker, one that understands high level what you're trying to accomplish, is so critical, because they can tell you what they believe the appraised value is without them running anything. And if the numbers look good, you can refinance that, and then you can go, because your income property is paid for this condo. You then can now go and buy something else with it. That's at year one. if for whatever reason it just doesn't work out with the appreciation, if it's not quite there, I find the next time, just from helping investors now over a decade, and now personally seeing over 100 people close on their pre-construction condo that we helped them purchase, the next sweet spot I think would be about 18 months to 2 years. And the reason being, and Luc, you know this as well, is that the first year that the condo is constructed, it's not pretty yet. We still have the elevators boarded up. We don't have the hallways painted yet. The concierge doesn't, they don't know what they're doing. You know, they're new hires. They have to build their systems. A lot of people are moving in. Let in the 2 years, let everything be fully completed in the condo as well. In the 2 years, you're going to see some turnover in your building. You're going to have people sell and buy. That'll establish the value of the specific condo. And I think the 18 months to 24 months is probably the sweet spot, you know, for accessing that appreciation. And, you know, based off of this hypothetical plan that we created, you putting in that 20% plus closing costs in your income property, it's what paid for two of your assets, 2 to 3.
Yeah, that's the
You know?
beautiful strategy. That's the beautiful strategy about this like real estate. It's because we can effectively access that capital. You did a great job at explaining it, but you can access that capital tax free. And it's
Yeah.
one of the legal ways in Canada to access that amount of money without having to pay taxes, right? Which is through getting a HELOC, which is through refinancing, and effectively every property that you purchase after that, or whatever comes in after that, it's free if you'd like to think of it that way, because you're using one property to pay for the other. You only ever have to pay for it once. And that is the beauty of compounding. Like my parents, for example, when they bought their home, this was about 13, 14 years ago. It wasn't until last year where they discovered the strategy of refinancing after having explained it to them that they were able to buy their second property. And they never actually
Yeah.
ever used their own cash to buy their second property. They used it through leveraging the equity in their home. So this is a
Yeah.
beautiful strategy of refinancing.
It's and it's, you know, this is a very simple, like, hypothetical plan, but, you know, if you set up your year one properly, and I think it's important to note, you know, you can't put all your eggs in one basket. We have a rule with pre-construction. You know, we try to get our insiders to only buy max 3 at one time, right? Because sometimes closings are too close. One condo could be, we can plan it out the best we can, but sometimes closings are really close, and then you're gonna need a lot of capital down at once for closing costs. So 3 at one time. But, you know, with pre-construction condos, you know, sometimes there is negative cash flow there. You know, you have, and it's quite, the insiders know, like, looking at negative cash flow versus the appreciation. You know, it doesn't matter if we're negative $500 a month, negative $6,000 a year. Your condo's appreciating more than that. But
Yeah.
regardless, you still have to pay that. And I think it's important to note, you know, to have some diversification is nice because you get a little bit of cash flow in one, it'll offset some negative cash flow in another, and the pre-construction will be appreciating. One, because it's a lower purchase price typically, so it has you're casting the largest net to the group of buyers who can purchase it and want to. Um, so typically we see that those ones appreciate the most, or the fastest, anyways, and so you're doing both,
Yeah, especially in
right?
the GTA.
And wow, 48 minutes went by fast, eh? So the the next point, question I hear from a lot, and I want you to kind of touch base on it. If investors want to purchase in a through a corporation for their pre-construction condo, what is the process there?
Yeah, so you're allowed to purchase with a corporation. You're allowed to purchase a pre-construction condo with a corporation. One thing to note is that the builder will need to have your personal name on the APS as well, the agreement of purchase and sale as well, just in case the corporation closes. They want also your personal name to be on title, just so you can assume responsibility of the purchase. And then on final closing, you're able to remove your name off the title and just close with the corp.
Hmm.
What a lot of times we do is we get an amendment during what we call the 10-day due diligence period, an amendment stating that if you're purchasing with a corp, you can remove your name from the title at final closing without any penalties. So that would probably be the safest way to do it, just so the builder doesn't charge you some fee or consider it an assignment if you were to remove your name from title at closing.
Okay. And are you seeing a lot of insiders using their corp to purchase?
Yeah, and a lot of times we negotiate for that kind of incentive anyway, just in case they don't even think, like, our insiders might not ever think of having a corporation, but in 3 years from now they decide that they wanted a corporation to invest in real estate with.
Yeah.
We always had that for them anyway, so that in case that were to happen, there's not like some silly fee that they're gonna end up having to pay just to do that.
Yeah, and it helps, right, with the ability to access the funds. Sometimes people are tapped out in their personal name,
Yeah,
as well as obviously the tax benefits.
completely.
So that's great. And then the one thing I did want, because I'm jumping back to motivation again. So we had about 200 discussions with insiders. 15 of our insiders over the last 2 weeks again did initiate a deal and did purchase a pre-construction unit. Were they all in the GTA?
The insiders?
Yeah.
No, I want to say about 70% were in the GTA, 20% were outside of the GTA, and 10% maybe outside of out of province, or maybe even
Nice.
20% out of province. Like, we have people from Alberta, BC, like people in Nova Scotia, people in, not often actually in Quebec, but a lot of people definitely out of province still.
Yeah, because it's passive, right? And
Yeah.
they could take advantage of the GTA's, all of the things that we look into as strengths in the GTA. They could take advantage of that.
Yeah, completely.
And in regards to the other investors who were considering it, but just wasn't right for them, what are those conversations like? What are the reasons why it just wasn't right for them at the time?
I think that's a great question. I think it comes down to affordability. I think people see 500 square feet condo for 600,000. I think that they think, well, uh, all the way out in London for 600 grand, I can get 2 units, a duplex, et cetera, et cetera. I completely agree with you. I think it just depends on the type of investor you are. If you want to invest, like yourself, Tyler, you invest in London. If you want to invest somewhere outside of the GTA, your appreciation not going to be that strong, but your cash flow will. And if you prefer cash flow, let us introduce you to somebody that will help you get some cash flow plays. A lot of our investors, they don't want to deal with a duplex because that means more doors, more headaches. And to them, they just want to focus on their job and let their money go for them in the background. And to those investors that are more of the passive appreciation type of investors, then we look at GTA core, or Toronto core, Toronto proper pre-construction.
Yeah.
I think the price per square foot, I think that's probably one of the things that scares away some investors, because they think that you can get a better deal elsewhere, which it's subjective. Because if we compare apples to apples, right, some of these buildings that we invest in, there's already units within that building selling for higher. Like, I had somebody who invested in a 2-bedroom for 787 grand in Mississauga, and for 11 square feet more, the nearest closest unit was selling for about 840. So there's that massive spread. Just for, I want to say maybe 830 was the closer guess to the number. So there's that massive spread and price point just for only 11 square feet. But what a lot of investors don't realize is you've already won at 787, because your neighbor in the exact same building, maybe with just 11 square feet more, is paying 30 to 40 grand more than you. That's a big win. That's a big win. So and people are paying for that, because we know, and also in some pockets in Mississauga, there's some buildings that are trading for a little over 1.1 million for 2 bedrooms. And there's a few. Yeah, there's a few of these buildings that I can name in the Mississauga city center. There's some closer to Port Credit, where 1 bedrooms are somewhere in the $800,000 range, 2 bedrooms closer to $1 million. Whereas in above condos, for example, and I keep referring to it because it was our most recent project, you can get something for about $1,100 per square foot, which is an absolute discount compared to
it's so funny.
projects.
I have that written down that I wanted to talk about it, because it's the price per square foot for above condos is specifically, when I heard about it, when we were after you and Jazz brought it to us to have the conversation, I couldn't believe it. I couldn't believe the price per square foot that they were offering there, 11 to 1150 price per square foot, because resale values are trading at 1,000 to 1050. This condo's not
Yeah.
gonna be ready for 5 years.
Yeah, you want to know what's so funny? I just realized this brunch was not supposed to be a pitch on above condos because we've allocated all of our
Yeah,
units at above condos. So it's not like we're trying to pitch anything. We're just kind of giving a real life testimony in terms of what's been happening. However, if anyone wanted to request a unit there because we are allocated, we can always ask on your behalf. Just email new builds, NEWBUILDS at reccanada.com, new builds at reccanada.com. Just let us know that you want a little bit more information. We can always request something for you or even have that discussion. But yeah, like just like a strategy like that, like neighboring projects were selling significantly higher in terms of price per square foot.
I don't think we can help our. Thanks, Nick. I don't think we can help ourselves or stop ourselves from just talking about strategies. You know, we talked about some of the real stories, but when we're together, man, we're so passionate. Everyone listening, live or with the recording, you should see us at the office. Like it's always about just going back and forth with market conditions and running performas, and it's just great. You know, that's why when you and I decided to do it together, I was so happy about it. I knew it was going to be a conversation like this.
Yeah, and
Um,
you know what, Tyler? Like we get so passionate about these projects. I just wish Jazz and Seamless can pay us more so we can buy every project we launch every single year.
oh, hey, Jazz, Simos, if you're listening. In regards to, and this one's going to be hard to answer, but I'm always interested to hear kind of because you're the one, boots to the ground, screening these opportunities with our new build division. In regards to the difference between current resale values to pre-construction condos, what is usually, do you have like a number for the difference that you usually see?
Yeah, I don't have an exact number, nor do I have a formula. Whenever we do our due diligence, anytime we launch a project, we always do our due diligence on even the resale market in the area. And on average, I'd say from the projects we've been working on, there's probably about a good 40 to $50,000 difference from resale values to pre-construction. It's not a significant difference. It's probably a good 1 year's worth of appreciation. I
Mm-hmm.
guess is a safe number to say. And the reason being is because normally the construction costs and the cost to build for these new construction projects are quite costly. So there always has to be a little bit of that premium for the builder to accommodate for a number of different things. All the expenses they have to pay, the paid legal fees, the realtor fees that they have to pay,
Delays,
all these
delays.
delays, construction costs. We were
Eh,
having
yeah.
go ahead.
No, I was gonna say, sorry for cutting you off. And they also, I imagine they also take into account not 5 years of appreciation, but some appreciation.
Completely, and like even a lot of the materials that builders use to construct these projects, a lot of them come from different countries. So what if
Mm-hmm.
even there's a little bit of a disruption in the supply chain, right? That adds more delays, right? A lot of these things come from Europe. A lot of our materials come from Europe, right?
Mm-hmm.
Pot lights, cabinets, things of that sort. So things of this nature we have to factor in, which is why there's that slight premium. But that premium, in my opinion, and the opinion of hundreds of our insiders that have done this, is worth it because we still get appreciation without having to close on
Yeah.
it. We still take advantage of extended deposit structures, et cetera, et cetera.
In regards, because I hear you talking about it, just very high level, just kind of a breakdown of a conservative appreciation. Why don't you break down that $600,000 one bedroom condo, like in the 5 years?
Completely. Yeah. So if we put down 5% on 600,000, that's going to be 30 grand that we're going to need in the first, call it 30 days, right? And nothing for 12 months in our most recent example. If the value goes up by 5% in year one, and we only put down 5%, that's a 100% return on our money. And we're very
Mm-hmm.
confident it's going to go up by 5%. And the reason being is because the Toronto Regional Real Estate Board has shown us over the last 40 years that values appreciate on average about 7.5%. So 5% is ultra conservative, even down and during the downturns, even in the great markets, the hot markets, 5% is a safe number. So let's just say 5% compounding over 4 years, for example, on 600,000. The number on that new appraised value is going to be 730 grand. If I buy something for 600,000 today and values go up 5% year over year for 4 years straight, the $600,000 condo will now be worth 730 grand. However, the balance on the mortgage, because I'm putting down 5% every single year for 4 years, is going to be 480 grand.
Yeah.
It's worth 730. The balance on the mortgage is 480. That difference of 250 grand is my equity. I've built $250,000 in equity. You're going to build $250,000 in equity, and you're not even going to close on it at that time. You're just closing on it. Never done anything. Now you have $250,000 in equity. That $250,000 in equity that you have sitting there, you can access that to refinance. How does that work? Some banks and lenders allow you to access up to 80% of 730 grand minus 480, which is the balance on the mortgage, which leaves you with $104,000 the day you close on. You get that through the form of a line of credit secured against your home, which is called a home equity line of credit. You're going to have $104,000. You're getting paid to close on this project. What do you do with that $104,000? You pay yourself back. So I'll break it down. If you put down 20% of 600,000, that's 120 grand of your own cash. But the day you close on it, you pull out 104,000. Now you're only left with 16 grand of your own cash that you use to purchase this now worth $730,000 condo. That's a great deal. To buy a condo for 16 grand of your own cash over 4 years, that's an amazing deal. 16 grand over 4 years, that's $4,000 a year.
And you get to keep the asset. I always say, even
And
with the refinanced amount, when you're doing the taking the mortgage out on the appraised value, it's through a home equity line of credit. That's how some of these lenders do it.
Yeah, so that's the way we would even recommend to do it, because you only ever pay interest on the amount you use.
Mm-hmm. So and I always say, with some of this refinanced amount, this is what I do anyways. I'll take some of that actual refinanced amount and put it into the slush fund to offset now the negative cash flow you're going to get.
Yeah, completely. There's a number of things we can do with that.
Yeah.
Yeah. Or what some of our investors do, Tyler, is we talked about multifamily investing pre-construction. What some of our investors do is they take that $100,000, they'll pay their 6%, 7% on the interest in today's market on the HELOC, but they'll reinvest it into a passive fund with some of our strategic partners and get a 12% annual return. So they're making that.
Yeah, you're seeing investors do that right now, like our insiders.
Well, yeah, like some of these companies that we work with in these securities, they're going to offer you, call it 12% a year. The interest on your HELOC is 7%. You're essentially taking the bank's money, investing it into a fund that's going to give you 12%. You take that 12%, you pay the bank back 7%, and you keep the 5% spread.
Yeah,
it's not even your own money.
And then all of these different partners, that's obviously an approximate number, but I think it's another example of why you diversify, right? And it's so important to understand what's out there. And I think I'm gonna toot my own horn. I think I do that really well, but I think that's what you do, Jazz does, Laura, Simeon does really well, which is, here are your options in front of you. Make the best decision for yourself. I'm here to help educate. I'm here to help show you what you can do with X amount of capital that you've told me you wanted to invest. Here are your options. And you're doing a great job. And I'm so happy that you were able to join us today. And before we go, again, everyone, we are having an event May 30th. It's a multifamily discussion. We're going to have Darren Boris join us. Starts at 6:30 at our office at the Shops at Don Mills. Anybody in the GTA, please join us. It's going to be a really good discussion. You also get to have some wine with us, and that's always fun as well. I'm going to have a great long weekend. I got some plans with the kids. Luc, what are you doing this weekend?
Just doing my thing. Probably gonna go enjoy a cigar now that the weather's nice. I'm thinking of doing a beach day. I never really planned it, but the weather looks really nice, so I might just take a trip down to the beach. Possibly the Bluffs. or maybe
I find
Woodbine.
I find the bluffs just, you know, because I grew up in Scarborough like yourself. When I was younger, even in high school, bro, you can go to the bluffs at any time. There's always parking, always, because
Yeah,
you got the two parking lots. Now it's it's so packed. If you're not there, you might have been even too late today for the bluffs.
way
Like
too late.
it's you have to park up the hill and then walk down the hill to go. And
Yeah,
I love the bluffs. The bluffs is great, but it's busy now.
yeah, yeah. You need to get
Woodbine's your
parking.
option.
Yeah, that's the thing with but Woodbine's also packed. Like you gotta get parking in these beaches like at by 9 AM. Otherwise it's like
Yeah,
80% full.
yeah. Well, you can go
Yeah,
to yeah. You're better off just Ubering or taking transit or something. You're paying 20
yeah,
bucks for parking anyways if you're going down the Woodbine. Well,
yeah,
that's great. Enjoy your long weekend. I'll see you on Tuesday.
yeah,
For everybody listening, thank you so much for spending your Sunday watching the Brunch with REC. Luke, you did a really good job just explaining pre-construction investing, kind of more high level. Congratulations to our 15 insiders who did take action. Um, we've talked about above condo specifically, the strengths there, but congratulations on taking action. It's time in the market, not timing the market, as they say. And for anyone else who needs any type of assistance, we are always here to have this conversation. Just email us at
yeah.
info@REC Canada, and we're here with we're here to give you some guidance. Enjoy your long weekend, everyone, and we're signing off. Thanks so much.
Thanks guys.